All right, we're going to do exercise 17-5 now. And this time we're going to have a an expense that is deducted for GAP that is not for tax, at least in year one. And so we're going to have some interesting differences come up here. So the first thing that we need to do is you can see on the problem 17-5, they've they've spelled out years 1, 2, and 3 for this company, and the only difference um, between tax and book income is going to be the estimated warranty cost versus the actual warranty costs that we use for tax purposes. So we have 110,000, um, or I'm sorry, 110 in estimated warranty costs in year one for book purposes, and no actual warranty costs in year two. And you can see they've already calculated our tax payable here. So in year one, um, what we have is 390 in book income before tax times a 40% tax rate. So our tax expense will be $156. All right. And so we see $200 in that one. So what we've got here, if we were to go ahead and make the entry, which is actually part of year two or part B down below, we would have tax expense is going to be 156 and taxes payable is going to be 200. All right, now this time we are not reversing a deferred tax liability, but we still need a debit to make this balance. And so what we're going to have here is deferred tax asset. Now, why is this an asset? Because we're paying our taxes in advance and we'll get to use that advance payment when we report our book income later, right? So it's something we'll get to use later for book purposes. So it's going to be a deferred tax asset of 44, and that should balance, right? Okay, so that would be our entry. But what we need to also do is create a T account and so that's going to be 44. Okay, now in year two, notice what happens here. I have 125. I have 125 in estimated warranty costs, and I have 200 in actual warranty costs. So that's 75 um, worth of income difference. My taxes would be for year two, tax will be 405 times 40%. And that will be 162. And as you can see, my tax liability, taxes payable, is 132. So what I would get here to record this entry is I'm going to have a $30 reversal here, right? $30 reversal. So my entry will be tax expense for 162 taxes payable for 132. And now I'm reversing the deferred tax asset for 30. Okay. Now we get to year 3. Now this is where it gets interesting because my GAAP income is 445, and that's going to be times 0.4 is 178. And of course they've calculated is 164, and actually that's going to be exactly right. The 14, and so the difference between 168 and the calculated 164 is 14, and so we end up with 0 in deferred tax asset, and our journal entry for that will be tax expense 178, deferred tax asset reversal will be the 14, and then taxes payable will be the 164. That's given. So that takes care of that parts A and B for both of those. So that's exercise 17-5.